If you are 60, 70, 80, or beyond, I need you to stop what you are doing and listen for the next 45 seconds. A lot of Americans, especially people who started collecting Social Security in their early 60s, only just discovered that their benefit may have been calculated wrong. Not dramatically wrong in most cases, but wrong enough that the difference, year after year, can quietly total tens of thousands of dollars by the time you reach your 80s. Before we go any further, save this number right now, 1-800-772-1213. That is the official Social Security Administration toll-free line, and the people who answer there can check your record for free. Memory slips, I get it, so write that number on a piece of paper and tape it to your refrigerator before you forget. Now I want to be very careful with the words I use in the rest of this video. I am not promising you a payday. The Social Security Administration does not send out surprise checks to every older American. What I'm telling you is that there are a handful of official reasons your monthly payment could be lower than it should be, and a handful of official forms and phone calls that can fix them. If even one of those reasons applies to you, doing nothing could mean leaving real money on the table. So let us walk through the 7 most common situations that have quietly cost older Americans from 60 all the way into their 80s, and exactly what you can do about each one. A quick note before we start. The rules I am sharing are based on current guidance from the official Social Security Administration website, the official Medicare website, and the Internal Revenue Service. Individual circumstances vary, so please verify your own situation with the official sources I will give you throughout this video. If this is helpful, tap the subscribe button and turn on the little bell so you do not miss the next video, because in a moment I will walk you through a brand new IRS deduction worth up to $6,000 that is only available for the next few tax years. The first situation is the one you clicked for. It is the idea that your benefit has been wrong since you started collecting. In most cases, this is not a scandal. It is usually one of 3 normal things that nobody ever explained to you. Number 1, your benefit is increased each year through a cost of living adjustment, also called a COLA, and the small base amounts are recomputed automatically. Number 2, if you started collecting before your full retirement age, you took a permanent reduction baked into the formula by law, and that reduction is rarely reversed. Number 3, your actual lifetime earnings record may contain mistakes, and if higher years of work were missing, your benefit would be calculated as if you earned less than you really did. Each one of these has an official remedy, and that is what we are going to cover. Let me give you the loss frame picture before the gain frame picture, because I want you to see the size of what is at stake. Suppose someone has been receiving around $2,000 per month since age 62 and turns out to have been underpaid by even $100 a month. Over 20 years, $100 a month adds up to $24,000 quietly lost. At $200 a month, you are looking at nearly $50,000. I am not saying that is your number. I am saying this is why we check. The $2,000 baseline I am using is a rough working figure, and your actual benefit will almost certainly be different, so please use your own numbers when you do the math for your household. Here's the first action step. Call 1-800-772-1213, which is the Social Security Administration. Ask the representative to mail you or to walk you through a complete earnings record statement for your lifetime. If anything looks wrong, misspellings, missing employers, years that show 0 when you know you worked, request a correction in writing. There is no application fee, there is no third-party company required, and you do not have to pay anyone to do this for you. If a representative says you need a Social Security advocate who charges a fee, hang up and call the official number again, because the official help is free. Keep watching, because the next reason seniors get shortchanged has to do with something called the Medicare Hold Harmless Rule. If you are 65 or older and you have Medicare Part B, listen carefully. Medicare Part B premium is the amount you pay each month for doctor visits and outpatient care, and the standard premium is $202.90 per month for 2026, up from $185 per month in 2025. Because of a rule called Hold Harmless, most beneficiaries whose Social Security is the only source of Medicare premium payment have their Part B premium increase capped, so their Social Security check does not actually shrink from one year to the next. Sounds good, right? The catch is that if your income ever dropped because you retired, you may be paying an income-related monthly adjustment amount, often shortened to IRMAA, which can add hundreds of dollars onto your Part B premium and onto your Part D drug plan premium. There is an official form called SSA 44, and its entire purpose is to let you ask Social Security to lower that surcharge after a life-changing event such as retirement, the death of a spouse, or a drop in work income. You file it with Social Security, not with Medicare, and the savings can be substantial. If your IRMAA surcharge disappears, you could keep several hundred extra dollars every single month. Now go back to that $2,000 baseline. Imagine how many months of premiums over 100, 200, 300 or more you have probably been paying without realizing you could have appealed. The exact amount varies for everyone, so verify your own premium with the official Medicare website at medicare.gov. The third situation is for anyone who took their Social Security before full retirement age and now wants to undo that decision. After full retirement age, which is 67 for most people born in 1960 or later, you can suspend your benefit, and for every year you delay past full retirement age up until age 70, your payment grows by about 8% per year, which is a guaranteed return backed by the federal government. If you took it early, you can still call 1-800-772-1213 and ask whether voluntary suspension makes sense for you. This is not a get-out-of-jail-free card for everyone because other family benefits and tax rules may change, but it is the single biggest guaranteed raise you will ever see in retirement. The fourth situation affects widows and widowers more than almost anyone else. The Social Security Survivor Benefit allows a surviving spouse to receive the larger of their own benefit or up to 100% of the late spouse's benefit. Many older Americans never switched over because nobody told them, and they have been collecting the smaller of the two amounts for years. Call the same official number, 1-800-772-1213, ask for a survivor benefit calculation in your specific case, and find out whether you are owed a higher monthly amount going forward or whether you may be eligible to receive a lump sum retroactive adjustment for up to 6 months. Social Security rules around these back payment windows change, so confirm current limits when you call. The fifth one is about taxes on your benefit. Most people do not realize that up to 85% of your Social Security can become taxable if your combined income crosses certain thresholds. The good news is that you are not powerless here. There is a free IRS form called W-4V, also known as the Voluntary Withholding Request, that lets you ask Social Security to withhold federal income tax right out of your monthly check, so you do not get blindsided by a tax bill in April. You can choose to withhold 7%, 10%, 12%, or 22%, or a flat dollar amount. It is not a deduction. It is just a smoother way to pay what you already owe, but it can save a retired household thousands of dollars in underpayment penalties every spring. Now, I want to be very careful here and give you a real example. Suppose your Social Security is around $2,000 a month, and you also collect a small pension and a small amount of interest from a savings account. You might owe federal income tax on a chunk of those benefits, and withholding through W-4V keeps April 15 from ruining your year. If withholding does not apply because your income is low enough, you may not need this form at all. Your tax situation is unique to you, so please verify your own bracket with a qualified tax professional or with the official IRS website. Here is the sixth reason so many seniors get shortchanged, and it is brand new. Thanks to the legislation commonly referred to as the One Big Beautiful Bill, there is now an additional deduction of $6,000 for individuals who are age 65 or older, on top of the regular standard deduction. According to the official IRS announcement I'm citing, this deduction is available for tax years 2025, 2026, 2027, and 2028. It is temporary. It is not automatic in the same way the standard deduction is, because some tax software may not apply it correctly, which means a quick check with your preparer could put up to $6,000 back in your pocket every single year for 4 years. $24,000 of potential deduction if you fully qualify for all 4 years, with your exact savings depending on your own tax bracket. Please confirm your eligibility through the official IRS website before you file. The seventh and final situation is just plain old mistakes on your record. Name misspellings, date of birth typos, employer names that do not match IRS records, years showing 0 when you really did earn income. Every one of those mistakes can quietly shrink your benefit because the formula runs on your top 35 years of earnings. Social Security allows you to file a correction request at no charge through the official website or by calling 1-800-772-1213, and the back pay adjustment, if one is owed, can be significant. Now I owe you a recap, because that was a lot, and I want you walking away with 7 concrete steps. Step 1. Call the official Social Security number and request your lifetime earnings record. Step 2. Ask about any IRMAA Medicare premium surcharge you may be paying and whether Form SSA 44 could lower it. Step 3. If you are past full retirement age and still working or able to delay, ask about voluntary suspension of benefits and the 8% annual delayed retirement credit up to age 70. Step 4. If you are a surviving spouse, ask about switching to the survivor benefit and any retroactive window that may still be open. Step 5. File IRS Form W-4V if you want taxes withheld from your Social Security to avoid an April surprise. Step 6. for tax years 2025 through 2028. Confirm with your tax preparer that the additional $6,000 senior deduction is being applied on top of your standard deduction. Step 7. Correct any errors on your earnings record so future COLA increases start from the right baseline. If this video helped you, please leave a comment telling me which of these 7 situations hit closest to home, because the comments help other viewers realize they are not alone. Share this video with one friend who is over 60, because the worst outcome is someone you care about leaving real money on the table for another year. Here is the truth I want you to remember. The Social Security Administration, Medicare, and the Internal Revenue Service together run hundreds of programs that quietly hand money back to older Americans, but almost none of them are automatic. You usually have to file a form, make a phone call, or check a box on your tax return. Just one of those actions could mean an extra $100 or more in your pocket every single month for the rest of your life. The phone number again, 1-800-772-1213. Save it, use it, and tell someone you love to do the same. Talk to you in the next video.